Homes are expensive and payments are bigger. Wages haven't kept up for 20 years, but somehow Canada has kept handing out high-risk mortgages like candy, even with tiny down payments, to people with zero Canadian credit history, even though we've had the highest or fastest interest rate spike in our country's modern history. No, guys, this is not a joke, it's reality. So this is another spicy episode. We'll help you answer who's getting approved for these mortgages and how does this impact every single Canadian? Because it does. And here's what you're not being told. Canada quietly created one of the most leveraged homeowner populations in the world. Let that one sink in. Just look at this. Canadians owe almost $1.82 for every dollar they earn after tax. Ridiculous. That's the highest debt load in the entire G7 and nearly triple that of families in Italy or Japan. And then Canada disguises those risks by shifting it off bank books and onto insurers, which ultimately means onto you and I. Merry Christmas. Because remember, when high ratio mortgage goes bad, the bank doesn't lose. The insurer pays the bill. And if that insurer is CMHC, for example, that means taxpayers are ultimately on the hook. Plain English, mortgage insurers are absorbing the fallout, backed by taxpayers, while lenders keep the profits and shrug off the risk. Isn't that nice? And you might think these programs were meant to help any first-time home buyers, right? Well, not exactly. These programs weren't designed for young Canadians struggling to break into the market. No. They're actually only designed for newcomers, meaning recent immigrants or permanent residents who haven't yet built a Canadian credit history. They could buy homes at the absolute top of the market, even with 5% down, even if they've only been here for 6 months, and even if they've never made a single financial footprint in Canada. That's not a joke, guys. Now let's continue. Many might be saying, who cares? My values are still being propped up. Oh, but you should care. And I'll tell you why in this episode. So, welcome to Canada. Would you like $1 million mortgage with that? And if you're one of the many Canadians asking yourself, why haven't prices crashed even further? This might be the piece of the puzzle that finally makes sense to you. So, let's dig in. Hey everyone, I'm Linda Ragona, and around here we dig into the stories that help make sense of this unfolding chaos. And let's face it, a lot doesn't make sense right now. The market's been, propped up. We can't deny that, and policies keep pushing it down a road that feels more like insanity than strategy. But that can only go on for so long, and today we're exposing the role that some of the most powerful institutions are playing in this. And just to help make sense of why it is the way it is. So let's talk about the Canadian mortgage program that has impacted every single one of us. Homeowners, renters, taxpayers, and essentially the next generation trying to build stability here. Canada's inflated real estate boom. And now we're kind of in a bust. It's not an accident. It's the product of policy, credit, and population engineering. When the Bank of Canada raised rates, prices should have fallen more than what they have. And in some areas, kind of didn't really drop anything substantially. Prices should have reset naturally, but instead of letting the market rebalance, Canada does what Canada does. They just imported demand. Now take a look at this. By Q1 of 2024, immigration hit a jaw-dropping 840,400 people, nearly 9 times the 2022 first quarter level. And between Q1 2022 and Q3 of 2025, the temporary resident population more than doubled to 3.02 million. Immigration surged at the exact moment credit conditions tightened to backfill what should have been a much larger slowdown. Coincidence? I think not. And on a side note, the foreign buyer ban that came into effect on January of 2023 didn't affect foreign workers with a valid work permit. There was always loopholes. Anyway, for any government in power, a slowing GDP looks, well, really bad. And politicians hate charts trending downwards unless it's talking about debt. Immigration is not the villain. I'm not saying that at all. Like I said in previous episodes, immigrants can benefit a country if they are absorbed for the right reasons. My parents are immigrants. People move here for safety, opportunity, and a better life. And that's a beautiful thing. The villain is a financial system layering risk and then hiding it. You can all see the agenda with the high immigration waves because it didn't make sense to bring in all these people and unload all of them onto our services, hospitals. Everything just got overwhelmed. When newcomers arrived, banks and insurers literally rolled out the red carpet. No Canadian credit history? No problem. Foreign income? We'll make it work. Only 5% down on $1 million home? Sure, we'll insure it. Come on in. In fact, all three of Canada's mortgage insurers offer near identical programs. CMHC's Newcomer program, Sagen's Newcomer to Canada program, which was formerly Genworth, and Canada Guaranty's Maple Leaf Advantage. Let me show you exactly how these programs work. I've actually seen some specifics like as little as 5% down, no Canadian credit history required, and international credit reports accepted. And you can qualify based on foreign income or assets. Sounds generous. Well, it is. And here's why you should care even though you don't qualify for the program. It's simply put, these loans are approved because the risk is insured, not by the banks, not by the politicians who brag about housing opportunities, but by yours truly, CMHC, Sagen, and Canada Guaranty, the big three. They're the ones guaranteeing high ratio mortgages for newcomers, meaning the lender gets all the upside and none of the downside. And that brings us to the most dangerous part, the loan to value rules. If a mortgage is 80% loan to value or higher, meaning 5 to 20% down, the maximum home value is $1.5 million. But if the loan to value is below 80%, meaning the lender bears the risk, the maximum home price is under $1 million. That's not a misprint, guys. That's policy, and it tells you everything. This isn't about affordability. It's about ensuring volume, commissions, profits, and shareholder returns, while the stress is pushed out of sight. Now, let's look at this as a whole. How big is this exposure? So let's go back to our chart again, comparing prices versus population. Canada's mortgage insurers hit a low point for high ratio mortgage originations in Q1 of 2023, about $11.3 billion. Then demand surged again, surprise, and by Q2 of 2025, high ratio mortgages reached $29.3 billion, almost tripling. And this is happening while prices are falling. What could go wrong? And Q3 of 2025, typical home prices have dropped almost 20% from the peak, down by about $169,000 on average, which means thousands of newcomers who bought at the peak could be underwater, stuck, at risk of negative equity, financially exposed if they need to move or leave Canada. And here's a statistic that should worry everyone. The unemployment rate for recent immigrants has surged to nearly 12%, almost double the national average. Even a fraction of these high leverage mortgages goes bad, it's not just a personal tragedy, it's systematic. Do you see the bigger picture here? Now let's talk about the domino effect. Insurers absorb losses, insurers need rescue, and then taxpayers get the bill. Get my drift? This is why every single Canadian should care. We've seen this movie before, just with different characters. Now here's where this gets uncomfortable. Canadian-born youth, they don't qualify for this kind of flexibility. Same affordability crisis, same credit barriers, but they get no tiny down payment access to $1.5 million homes, No alternative documentation. No, just an HST rebate. We are literally giving better mortgage privileges to someone who arrived this year than to someone who's paid Canadian taxes since grade 9. The media loves to talk about equality. What's this called? And I can tell you what I call it. That is risk transfer disguised as opportunity, because lenders aren't trying to help immigrants. They're trying to maintain home prices and volume. Politicians trying to keep GDP propped up. Let's call it as it is. And if these loans fall apart, the lender doesn't lose. The Canadians lose because we're the ones fronting the bill. Every single one of us. Isn't that nice? Disguised as another tax, of course, putting aside that we're taxed to oblivion as it is. The reason for these programs was to solve a real issue. Newcomers face systematic barriers in credit access. We should help them. We should help them succeed. We want them to be a part of our shared prosperity, fully integrated into a society that values their contribution, not a system that quietly sets them up to risk. And we have to stop pretending that high risk leverage keeps housing affordable or that it helps these families in the long term. It doesn't. It keeps housing expensive and very fragile. You can't solve a housing crisis by giving more risky mortgages. And we cannot keep shifting risk to the people least able to understand it, which is young families, renters, newcomers, while the institutions ranking in profits take zero accountability. So here's what should happen. Mortgage insurers must disclose exposure data regularly, performance data and delinquency rates, and regional loan-to-value breakdowns. Ottawa must limit program use, no speculative lending, no inflated appraisals. Young Canadians deserve equivalent credit flexibility. If we help newcomers, we must help our kids too, simply put. And real estate policy must reflect reality. Borrower quality matters and income matters, and risk matters very much, because pretending everything is fine is exactly how you get a cascading credit shock that nobody can absorb. Essentially, not in a country that already has one of the highest household debt levels in the G7. So if you found this video eye-opening and believe Canadians deserve transparency, hit like and comment and share this with someone who thinks everything is normal. And if you have questions about the Greater Toronto Area real estate market, we would love to hear from you. Thank you so much for watching. Stay informed, stay empowered, and we'll see you in the next one. Bye for now.